What do you think about this triple witching day? The impact, again, we just mentioned it, $5 trillion in expiring options. How do you see it impacting the day ahead?
I think it's just going to add a little more volatility. I feel like over time, these have been less and less impactful to the market, but a little more volatility, that could be okay. It could just be a little opportunity for investors on the morning.
So, Robert, same question. I'm concerned about this big liquidity event, and also we have these rebalancings that are happening after the bell.
Not really any concern in the short term. I think a lot of investors are really catching up to the news that's come out of the Fed and on the inflation front. That's the good news side of it. I think the bad news side of it is we've maybe pulled some of next year's anticipated gains into this year, setting up the stage for a little more nuance required going forward into the new year.
Now, when you say that some of these gains might be pulled forward, what do you mean? Because right now we actually seem to be seeing kind of a broadening of the market right now. Small caps, real estate, all rallying this week, along with biotech, generally some pretty interest rate sensitive sectors.
Yes, absolutely. I think the broadening out is great. I think that's going to continue. I think the small caps still have some more room to run.
Right.
On the large cap side, if you look back to the rally that's taken place since late October, we've come a pretty long way in a short time and anticipating rate cuts, which I think will come, but we've priced a lot of those in now. So I think on the large cap side, you need to be a little more earnings sensitive for next year. While, as you point out, I agree, small caps still have some more room to run here on this rate trade.
So, Lindsey, what about you? I mean, we saw earnings estimates. They've been kind of volatile for Q4. What are you looking at as we go forward? Do you believe that the rally is going to continue to broaden out, or are you still focused on what's been working all year long?
A little bit of both, actually, Frank. I do think that what happened this week, the Fed basically gave the green light to the market to really broaden out their investment thesis. What we heard from the Fed really provided clarity on rates going forward. And it also, in a way, I think gave investors what they were looking for in terms of when a soft landing is happening. And it seems like we're going through that. That was supported, I think, yesterday with some of the jobless claims and retail sales data that you got. So I think investors are feeling more upbeat and more excited about putting their money to work. Like a lot of cash has been sitting on the sideline. Right. And this really does open up that opportunity. As you said, you are starting to see some of the lagging sectors begin to pick up, which is a good, healthy trend in the market.
So, Lindsey, as you say, investors are kind of broadening out what they're looking at. I think something may have changed a bit, at least when you look at fixed income. Before, fixed income was really competing with stocks and even dividend-paying stocks, something I know that you really focus on. Right now, has your view of fixed income, has it changed dramatically as we see rates continue to fall?
Yeah, I mean, I think there is still opportunity in the fixed income space, but I do think that those rate-sensitive sectors are becoming more interesting now, and with rates falling, they are competition again. And so what I'm looking at is the dividend aristocrats. Those have always been a defensive play, secure play, and over the long run typically outperform the S&P 500. I do think investing in quality in 2024 is going to be a theme that really does stick. So dividend aristocrats is a place that I think it's finally time to put your toe in. Granted, they have had a big pop in the last couple weeks. As the Fed move was anticipated.
Right. But you think they still have a little bit more room to run?
Yeah, I do think they have room to run.
So, Robert, I want to come over to you. Talking about what's been working all year long is the Magnificent Seven, the AI play. What's your view on that right now? I know you said you're paying more attention to earnings, but in general, do you believe that next year we could see another rally for these names? Just yesterday, we had a note come out that Apple's going to outperform again next year, and we saw it just kind of tick up in the pre-market, trading pretty close to an all-time high still.
I think there is still some room to go there. I think in a slow growth world, you pay up for growth, and a lot of those companies have great organic growth, great balance sheets. All the things that we've liked about them the past few years continue to be true. Although I do think the broadening out will play out in a pretty meaningful way next year. So I think we have to be a little bit more selective, look for those areas that are benefiting from CapEx spending, look for those areas that are benefiting from potential margin gains. I think that's really where the excitement will come in earnings next year, is from companies able to post higher margins.
Yeah, a lot of people have been talking about companies with margin expansion or dividend increases, but I just want to come back to the Magnificent Seven for a second. Do you see this as a rising tide that continues to lift all those companies, or do you think investors are going to start to maybe just take a closer look at the AI story, the robotics story, the automation story?
No, I think it's going to be more a case of the laggards catching up rather than the leaders falling.
Lindsey, before we get out of here, I just want to get a sense today, as we look at today, again, potential a lot of volatility coming up, triple witching, also a rebalancing of the S&P 500 and the NASDAQ 100. Where would you put money to work today? What are you looking at?
Well, like I said, it's for me, it's all about quality, and I like some of the things that the other guests talked about, margin expansion and CapEx spending. But I also like the healthcare sector. It's been a laggard this year, Frank. It's one of the 4 sectors is actually down on the year. It's very reliable in uncertain economic environments. The valuations look reasonable at this point in time, and there's secular tailwinds that can benefit the sector. So that's another area I would consider diving or tiptoeing into at this point.
All right, so Robert, same question for you before we let you go. I know you said you're looking at small caps. Any other areas you're looking at, especially as we go into the holiday season? We're going to get another read on the consumer over these next 2 weeks.
Yeah, beyond small caps, in the large cap space, I think technology will continue to do well. Companies, again, with CapEx and chasing efficiencies. And I think the consumer sector will continue to do well. We're still adding jobs. We're still adding income, and consumers will be continuing to spend through the new year.
Let's drill down a little bit. When you say the consumer sector, what kind of names are you talking about?
I think anywhere where you have direct benefits to people being put to work and having income. So places like retail, and again, have to be selective. And I agree with what Lindsey was saying on the quality point. But places that will be benefiting from growing incomes are where you're likely to see earnings gains there.